Hello and welcome to Portfolio Matters. Exciting day today because we have Luke Oldfield on. Now, when Richard and I started this podcast, we thought the aim was to try and connect with private investors, all of whom are stuck in their private offices researching companies, and there seemed no way of accessing that information. Now, Luke has very kindly got in touch with us and provided a stream of stock comments about companies I'd never heard of. So we thought logically the best thing to do was to get him on the program to talk about these small companies and share his knowledge with our audience. But before we do that, Richard will read the disclaimer.
Thank you, Keith, and welcome to Luke. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. The views of any guests we may have on the show are entirely their own and may not be representative of the views of Portfolio Matters. A full disclaimer can be found at the end.
So welcome, Luke. Why don't we start off by Luke introducing yourself and just telling us how you come across these companies and about your investment style?
Yeah, hi guys. So thanks for having me on the show. By profession, I am a fund accountant for a small agency of the UK Treasury. And I've been there about 10 years, and we deal with mostly vanilla products like gilts, treasury bills, and we help raise government debt. So that's my sort of professional background. As an investor, I would say I've probably had two investment careers, short careers so far. I started in, I would say, about 2009, as we were recovering from the stock market crash. And I was a bit wet behind the ears back in those days, and got easily sucked into the hype of various stocks being talked about on bulletin boards. But I made a great deal of success with a number of precious metals and oil exploration companies, and then rather quickly lost most of that. So it was a quite chastening learning experience. After that, I took a break for a while to buy myself a flat and recover some funds, and I gave it another crack. Around about 2017, I would say I started. By then, I'd got my full accountancy qualification behind me. I've learned some lessons, and I started off much slower with index fund investments and peer-to-peer lending. And I sort of realised you need to do a lot more research in this game to be confident about what you're doing.
What do you use now, Luke?
So now primarily I use ADVFN, which I find the best bulletin board. Every stock on there has its own thread, and many of them have multiple threads, sometimes with different focus. So some of it will be around charting, and some of it will be and short-term trading, and some of it will be more long-term detailed analysis on stock.
How do you go about picking the stocks on ADVFN that you're interested in? What's your selection process?
It's kind of come about organically, really. I first started just looking at a share that you've already covered called Anglo-Asian Mining, and I rather fortunately found the main thread on ADFN had some absolutely brilliant posters with a great deal of knowledge about the company, far more knowledgeable than you will find out anywhere else. So I kind of quickly got to suss out who knew what they were talking about and who didn't. And from there, I kind of got chatting to certain people and followed their investments. And occasionally people will post off-topic tips about other shares they're invested in.
Right.
And so it sort of branches out from there, really.
Yeah.
But more recently, one of the guys off that board set up his own thread. to talk about stocks and trading ideas in general. And that has attracted a group of core investors who are really, really knowledgeable. And a lot of them post tips on there. And as one of them is running a stock picking competition. It's an annual competition, so you pick one stock for the whole year,
right.
And winner takes all, basically. This is virtual money. And there's also a weekly one which has a cumulative balance running, and that's a really great for highlighting stocks, because people have to give their rationale for what they think stocks are going to do well next week, and a big write-up for the annual one.
A great introduction, Luke. And would you like to tell us about the first stock that you have?
Yes, thanks, Richard. So I thought we would kick off first with Avacta. This is a share that is on a bit of a roll at the moment. If you check the share price from this week, when I put this presentation together, the shares had ended just under £2 a share last week, but as at close of business today, they've hit 250 pence, so 20% or so up, which is very pleasing for me. But I haven't sold a single share because I'm in this for the long term. So the market cap is actually over £600 million at the moment. This is a pharmaceutical company, and I would also classify them as a technology company, really. They've got £50 million cash on the balance sheet, having done a couple of placements in the last sort of 12 months, and a big one at I think it was around about 120 pence a share. So I bought into them when they were about 27 pence a share, so it's done pretty well. And the reason I bought in is I was interested in this Avacta technology, and this is a technology that's patented by Avacta. Avamas are similar to antibodies, human antibodies. They're essentially engineered proteins, but they're smaller, quick and easy to manufacture in scale, and very easy to format. And these have multiple uses in both diagnostics and therapeutics, both of which Avacta do. Avacta as a company, they have multiple global partnerships signed up, and if you check on their presentations, you can see the names of the companies that they're involved with. License out this Avacta technology to other companies who are developing drugs. Avacta don't develop drugs themselves, they license out the Avamas to other companies, and then they will receive royalties as these drugs go into production. I see a couple of catalysts for real share price growth with this company. The near-term catalyst is going to be in the COVID-19 testing space, and they have what I would describe as a best-in-class lateral flow test currently undergoing clinical trials, which is expected to get accreditation by the end of March, so literally in the next couple of weeks. They're part of the UK's government Condor programme, and this lateral flow test is described as a second generation lateral flow test. So the ones that are in the market at the moment that are being used in schools are from a company called Innova, a US manufacturer, and the UK government has spent well over £1 billion on these tests. So Avacta's second generation lateral flow test has undergone clinical trials already and proved 96.7% sensitivity, which compared to the ones in the market that are being used in schools at the moment are only 77% sensitivity. So this is a great deal better, and I think stands in a good chance of picking up government contracts going forward. In fact, in the last week, I've seen tenders out for £8 billion for COVID lateral flow tests over the next 4 years, and a separate tender for £4 billion for COVID related equipment. So there's a large market out there. They have multiple worldwide manufacturing partnerships signed up already, and the CEO has said they'd be ready to go with several million lateral flow tests per month capacity to start up with, and that can be ramped up very quickly. There are actually larger clinical trials currently underway, and the results of those are expected at the end of this month. That will give them the accreditation they need to sign up contracts, in my opinion. We also had an RNS very recently just to confirm that their lateral flow test does detect both the new variants of COVID and also that AFMA reagents can be rapidly developed for any new variants and indeed any new future pandemic viruses. In the medium term, and this is why I really bought in, they have a phase 1 clinical trial drug under development. So I say Avacta don't actually develop drugs. This one is they modify drugs. So in the cancer market with chemotherapy drugs, they're highly toxic. So the medium-term catalyst I see for the company is this phase 1 clinical trial has been authorized for AVA6000, which is a doxorubicin chemotherapy drug. The company, they do not, this is an existing chemotherapy drug, and the company's technology modifies this drug so that it only activates when in contact with tumors in the body, so that it doesn't attack healthy cells. And it's been proven in animal trials so far to be 18 times more effective than the standard drugs on the market. Human trials for this modified drug are going to begin this summer, and results will be with us by the end of the year. Doxorubicin is a generic chemo drug, and it's already a $2 billion annual revenue drug. Avacta have indicated that they would be looking for a 5 to 10% royalty, annual royalty, on top of development milestones. The whole market itself is expected to grow up to $56 billion by 2024, and Avacta have a number of other similar drugs that they believe they can modify that are in the pipeline. So huge potential. This, they believe, really opens up a pipeline of next generation chemotherapy drugs for the company that hopefully will provide significant commercial value.
Thank you very much for that, Luke. It's very interesting. It's a company I'd never heard of, and it's very nice to get an introduction to it. Now, one of the reasons I generally avoid these health and pharmaceutical space is because I think it does require quite a lot of specialist knowledge. So do you feel that you have enough knowledge to evaluate these companies? And if so, how did you arrive at that knowledge?
That's a very good question. Obviously, I'm not a scientist, so I'm taking a little bit of a gamble here that their technology is going to prove that it works. I'm sort of encouraged by the number of global partnerships that they have already signed up with big pharma companies, and the amount of money they're able to raise at 120 pence per share. The way I see it, they're not actually developing new drugs from scratch. This is simply a technology that activates the drug once it hits certain enzyme, I believe, in the body. And if that can be proven in animals and in vitro, I know we're not mice, but logically I think there's a fairly good chance that it will work. And I don't think it needs to be anywhere near as successful as it has been proven in mice.
The current market cap, Luke, I think is around about £550 million, and their revenue, this is from Stockopedia, their revenue looks like it's about £5 million a year. Now, clearly, there's value in the royalties, but they are on a multiple of 60 times sales, and that's quite chunky. So where do you think the upside from this point might be?
Well, as an accountant, I should be looking at the numbers, but I'm kind of ignoring prior year financials, because this is a company that's been underfunded, and most of its technology is all preclinical. So it's one that's got potential explosive growth, because if they are successful with the drugs, you've seen 5 to 10% of the chemo market. This is 56 billion pounds potential that they can get a share of.
Yeah, and of course, I think you yourself have experienced quite a lot of upside from this share. But the question is, if someone comes in now, well, how much further upside is there to be gained?
One of the things I'd say is that, if Avacta can get it right and the technology is adopted, then the returns could be similar to BioNTech, where, for years it's struggling. Well, it's not struggling, but it doesn't have a product. And then when the product is adopted, then massive revenues and the share goes through the roof. But really, you have to have the patience for that to be adopted and to believe that in the technology and the technology to prove itself.
Yeah, I think there's a certain underpinning to the market cap based on this COVID testing. Yeah. The results have been so good. I can't see, and then the UK government is desperate for a sovereign test. Yeah. There's not many that are out there at the moment, and I'm pretty sure they're going to be able to sell everything they can manufacture. So I think that revenue is going to underpin the growth of the business to a certain extent, as well as the cancer treatment stuff.
Okay, so Luke, shall we move on to Open Orphan?
Yep. Okay. So Open Orphan, another British company. They are world leaders in testing vaccines and antivirals using human challenge studies. So they're a pharmaceutical services company. The advantage of challenge studies is they speed up vaccine development, and they're cheaper and more expansive than in-field testing. I like this company because the CEO has invested several £million of his own cash into the business. In fact, he has 20% of the shares, so he's well aligned with shareholders. And what he did was he took over formerly loss-making businesses. They made an acquisition of hVivo, which is the business that does the challenge studies, and he's streamlined those businesses, cut out all R&D spending, development, gutted a lot of the senior management to trim down the cost, and as of Q4, the businesses, we're told, are now profitable. Fortunately, we don't have a full set of accounts for the most recent year to prove that, but this is what we're told. I'm also very encouraged by the rapid expansion of the challenge study clinical trials. When I first invested, the company had 1 clinic. Now they have 3. And one of those is the London Free Hospital that the government actually has allowed them to use for free in order to carry out COVID-19 human challenge model studies with a recent £46 million contract from the government. You might have seen a bit of press about that on the BBC under hVivo. We're told they're fully booked out for human challenge studies until mid-2022, so a lot of demand and studies in the pipeline. So I think this core business underpins the current market cap. We're told that each clinic can do 40 to 50 million pounds of revenue annually, and these types of businesses, I'm guided that they typically valued at 2 to 3 times annual revenue. But what I'm really excited about is this disease in motion digital platform. Basically, all of the challenge study data they collect, they have a huge database of obviously how the body is affected by certain drugs and vaccinations, and some large tech and pharma companies have been in contact with a view to purchasing this information, either outright, the databases, or via a licensing deal. And CEO has mentioned on several occasions in recent interviews this could be worth more than the market cap on itself alone. So this is something that I think is not in the share price at all. The second bit of value driver that I think is also not in the share price is that there are 3 non-core businesses that are up for sale that the CEO has guided he's looking to sell within the next few months. The biggest one is a company called Immutex. That is a stage 3 ready universal flu vaccine that's Orphan own 49% of with a joint venture. And again, the CEO has said that similar US peer companies at this stage 3 are typically in the $300 to $500 million market cap range. Obviously, Orphan own half of that. If he can sell these, he's going to give all the money back to shareholders via a dividend. He can't actually get any money out of the business himself because his shares are tied up for the next 18 months. So I think he's quite keen to monetize some of these assets. I've listed another one here, Prep Biopharm, a viral prophylactic of expected utility against COVID-19. And there's another one, an immune modulator, but we have no real guidance about the value of those. Just lastly, I want to say the pipeline of vaccine companies seeking challenge studies, they do conventional non-COVID ones, about £4 or £5 million per contract, and COVID ones are much more valuable at £8 to £10 million. And just lastly, to give you a bit of idea about the demand, the new clinic that they bought in Whitechapel, I think, this was a hotel they refurbished into a clinic for testing. The client actually paid to refurbish this clinic on behalf of Orphan because they were that keen to get their vaccine studies up and running.
Great. Actually, that company sounds very interesting. The question I would have for you, though, Luke, is, obviously the last year has been very positive for this sort of company, and there is a great deal of investment in vaccines at the moment. But going forward, do you think that there will be enough of it in the following years to justify, further growth in the share price?
Well, that's a subjective one, really. I think probably this COVID has highlighted the lack of investment in this kind of industry recently, given how unprepared we have been. So I think companies have seen really how lucrative these COVID vaccines are. So I think that's going to probably encourage a bit more spending in the industry.
I think one of the things also is that there's been, it would seem, wouldn't it, that actually our knowledge of how to make a good vaccine far exceeds our ability to make a good vaccine. And technology that was pre-existing suddenly came into its own in March 2020. And I think maybe what's happening is that the pharmaceutical industry in general is starting to catch up with the technological opportunities available from things we actually already know, but have slightly fallen by the wayside. And both of these are examples of that, aren't they? And these Aphamirs, which I'd never heard of, being used in place of antibodies, and clearly it's a lot easier to make an Aphamir, which might be, 20 amino acids long, than to produce a monoclonal antibody. So it strikes me that these companies are cashing in on technology that hasn't really been exploited to its full.
Yeah, I think the good thing about this business is there's no other company in the UK that runs these challenge studies. So they have a bit of a moat around them. It takes a long time to build up the knowledge about how to do this, and also the reputation. So I think anybody that's looking to run these trials, they want to go to a company that's already doing it with a history, because it's such a risky thing. There was one final point I just wanted to make. Is that the CEO also said that he'd been recently contacted by Chinese companies that were looking to set up challenge studies in China, and he's quite happy to be paid to give his advice and maybe even franchise the business.
Good.
Great. No further details on that yet.
Good. Thank you, Luke. So that's very interesting. And what is your third company?
So the third company is changing tacks. This is Touchstone Exploration. They are an oil and gas exploration and production company in Trinidad. I've been in this one since mid-2018, when they were a small cap producer with a market cap of around 20 to 30 million, and they've grown phenomenally in the last couple of years due to a great deal of exploration success. What I like about this business is it's onshore drilling, which is comparatively cheap. The wells cost between $4 and $6 million each, whereas offshore you're paying a lot more. They've had 4 out of 4 successful exploration drills to date, and they have a pipeline of around 21 further exploration targets identified, which could keep them busy for the next 5 to 10 years. Of those 4 discoveries, only 2 have been flow tested to date. The latter 2 have been delayed slightly by not being able to get the right equipment. In fact, because the drills they did encounter so much pressure, they couldn't actually get down as deep as they wanted to, so they've had to wait to get hold of better equipment. So we're due results on those in the next month or 2. And I think because of those delays, that's why the share price is off its highs at the moment. I also like the fact that they recently signed a very large contract with the National Gas Company of Trinidad with a value of $1.62 billion. They have basically said they will take any and all gas that they can find, such as the demand in Trinidad. And because it's so much cheaper than offshore gas, they're quite happy to do so. The value of that gas is going to be around about $2.50 per million cubic feet, and the operating cost less than around 5 cents, we're told. So a really high margin. The only downside is that the tax regime in Trinidad is fairly punitive.
Right.
So the second slide just gives a bit of information about what production is expected to come on stream. The first of the discoveries is coming on stream in April.
Wow.
But, yeah, that's a smaller one. That's 10 million cubic feet, and that's going to give them around $500,000 of cash flow per month. The larger developments are coming on stream in Q4 2021, and all of this infrastructure is being paid by the National Gas Company. So Touchstone aren't going to need to take out a load of debt to fund this. And I think once the developments come on stream, there's going to be quite a chunk of cash, more than they need to get on with the rest of the exploration. And there's been talk that they'll be potentially paying out dividends from 2022.
Wow. Well, great. Thank you, Luke, because I mean, as regular viewers of the podcast will know, I quite like a small oil company. Yeah. And this one I have completely missed, which is rather disappointing given the enormous growth in the share price, and you've done very well on it. And actually, I think that's a great introduction, and I can see that there are some near-term drivers for growth. Can you just talk us through quickly the tax regime?
Yeah, so the gas side of things, there's a 12.5% royalty.
Yeah,
not too bad. But then there's a 50% profit production tax. And I understand that there are certain deductibles from that, such as capital expenditure, depreciation, and exploration expenditure. So apparently the company have guided that they're modelling tax to be around about 35% of gross revenue. So that's what I'm using in my forecast as a ballpark.
Great. Okay. Interesting. Richard, any questions?
No, it's fascinating. I say well done for coming across these, Luke, and for digging them out, because it's interesting to see these little gems lurking underneath the radar, if I can mix my metaphors a bit.
Yes.
And I think your mechanism by which you found them is very interesting. And I, for one, I'm going to start having a little exploration of ADVFN, which isn't a site that I've used. And well done. And clearly, you have made some very satisfactory investments here, and you clearly understand the companies that you're investing in and why you're continuing to hold them. And I think that's great.
Great. And I, on the other hand, will be relying on Luke to give me a call whenever he finds something of interest, because then returns to discovering some of these early stage investments are extraordinary, and you've done very well. And I will now be looking closely at Touchstone in particular, but also Open Orphan, because I think in the case of Touchstone, what had put me off was the very high share price. In fact, it's done so well, but you described there's a lot of further upside. They've got another 21 wells to drill.
Yeah, the biggest exploration drill is coming in Q4 this year, called Royston, and that's actually named after the CEO's father. So I think he's hoping that's going to be a success. What I liked about Touchstone is that the whole block was actually drilled in the 1950s and the 1960s. So it's not wildcat drilling. These targets have actually been drilled but not tested.
Right.
So that's what gave me thought it would be a good shot. As it turns out,
it's not entirely speculative. There's a understanding of what's already there.
Yeah. So I think there's a higher chance of success than you would normally expect with exploration drilling.
Great. Well, thank you very much, Luke. I think it would be great to have you on again in a few months' time to share your updates on these three companies and any new companies you may have come across that could be of interest to our viewers.
I think one of the things we struggle with and hope to introduce into our audience is small companies that we're previously unaware of. So thank you very much for that intro.
No problem.
I think all that remains to say is thank you to Luke, and I hope everyone enjoyed that. You will press like and subscribe to the channel. And if anyone else out there also has some expertise that they would like to share with the audience, please can you email us at info@portfoliomatters.co.uk. And thank you to Luke.
Thank you very much, Luke. So
thanks for having me on, guys.
It's a pleasure, and hope to see you again.
Yeah,
yes,
let's keep in touch.
absolutely.
So it's goodbye from all of us.
Goodbye.
Goodbye.
Bye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.